I want to bring in Torsten Slok now to talk about reopening and the economy. He is the chief economist at Deutsche Securities. Torsten, it's good to see you. If you can unmute yourself, we can talk about what this economic situation will look like. I know you're you're focusing on states and regions across the United States and the unemployment picture. What then is this sort of patchwork reopening going to mean for a potential regrowth in the economy?
Yeah, this is really important. I mean, one very important dimension that makes today very different from 2008 and 9 is that the unemployment rate in some states has gone up much more than in other states. If you take Utah, take South Dakota, the unemployment rate there is only like 6, 7, 8%. But in other states like Michigan and Pennsylvania, the unemployment rate is 25, 30%. So that means that there are huge, huge differences in the starting point for this recovery. In some sense, you could almost start thinking about, well, which consumer in better shape? And those consumers that are in better shape should generally also imply that you should have a faster rebound and therefore more cash flow coming to the bottom line of corporate. So therefore, the very important part of your question, Julie, here is that yes, and what today's so different is that some states did go into a lockdown and others didn't. And those that didn't now look better simply because they did not see such a significant increase in the unemployment rate as we have seen in other states. And that makes the starting point for where we stand right. We probably have the worst behind us in terms of economic data, but makes the starting point very different from 2008 and 9, where everything went up and down in sync. The unemployment rate went up and then it went down.
Torsten, it's Adam. Good to see you. The worst may be behind us at this point, but this was so dramatic and so quickly. And with the places that are reopening, they're limiting capacity at 25%, even at 50%. You can't make a profit. So what kind of further stimulus is this economy in the U.S. going to need from Congress?
Absolutely. So, I mean, we were clearly with the unemployment rate, we went up the elevator and we're definitely going down the escalator. It's going to take quite some time to get the unemployment rate down. The Congressional Budget Office estimates that the unemployment rate at the end of this year will be 10%. So in other words, if we do get 18% on Friday, where the numbers, which is what we expect, it will take quite some time before we get back to the 3.5 that we had in February. So to your question, what is needed? I mean, the conversation is beginning to change away from just liquidity support, just supporting households with some temporary money, just supporting small businesses with some temporary money and loan, basically now to a conversation about solvency. Are so solvent the problems we're seeing in mortgage markets and commercial real estate? Those solvency conversations are opening up questions about maybe we saw more people not pay their rents on April the 1st and on May the 1st. But if you get to the 1st, you get to the most important indicator is the 90-day delinquency rate. And the 90-day delinquency rate across different kinds of asset classes does become very important. So that's why when we're looking out for more signs of this switching from a liquidity conversation to a solvency conversation, we're looking for underperformance of auto loans, credit cards, commercial real estate, residential mortgages. We're seeing the cascading showing up elsewhere. And this is back to your question, probably a good indicator for whether more support is coming from Washington, D.C. or not.
Torsten, hi, Rick Newman here. I want to ask you this question about, is the worst really over? Some of the analysis I've seen shows that the overall rates of infection and death in the United States are improving largely because they're improving in just 3 states here in the Northeast, New York, New Jersey, and Connecticut, but that the measures for many of the other states are actually getting worse. So what are you actually modeling when you're trying to figure out where this is headed?
No, you're absolutely right, Rick. That's why for equity investors and credit investors, it actually becomes a whole new dimension of investing. The things that we've been talking about for many other factors driving markets, and a whole new factor driving markets now is exactly this issue of asking the question. The company I'm looking at, that in the tri-state area, where you probably will see now, at least in the next few weeks, when there's numbers down, you will probably see some signs of corporate cash flows beginning to come back. Whereas in those states that are still seeing rising numbers in terms of the number of new coronavirus cases, they're probably going to be at least more vulnerable from that dimension. So it is a whole new thing to begin to think about in which states are we seeing the virus curve flattening out and which states are we not. And this becomes critical also in the conversation about the reopening and this issue of what is the starting point with the unemployment rate. So that's why, from a equity perspective, there are really 3 dimensions, namely who will first reopen. That, of course, will be helpful, broadening in terms of thinking about what are the opportunities for seeing cash flow. But the next question is, well, what is the unemployment rate in those countries? What are consumers' purchasing power, if you will, if they can really go out and buy or if they can't go out and buy? And the third and final thing is also this, well, okay, that's all helpful. But if the curve does begin to reaccelerate, to your point, you could get worried about some of these states that are more aggressive to others.
Torsten, this is Dan Howley. I kind of want to go into whether or not we'll start to see consumers come back right away, or if they will kind of slowly trickle in, kind of getting testing the water to see whether or not it's safe to go to certain areas. I guess, how big of an impact will that have on the balance sheets of companies who are relying on people to come in droves to prop them back up from the losses that they've suffered?
Absolutely, Dan, and this is a very important question. So people that are more than 65 years old, they account for 20% of consumer spending. People that are more than 55 years old account for 40% of total consumer spending. And given the risk to the older generations, there's significant risk to consumer spending overall. And this is not only restaurants, cruise lines, and airplanes. This is also risk to durable goods. We're already seeing in some of the data from the autos numbers that people that are more than 55 years old, they are not out shopping cars the way the younger generations are. So you're absolutely right, Dan, to your question. Not only will we see some health requirements about distancing in crowds, sporting events, concerts, airplanes, but you will also probably see reluctancy, in particular among older generations. So that's why this gets back to that. This is just a whole different dimension of investing. This is why the quant models and all those who just have simple mathematical frameworks and sophisticated mathematical frameworks for thinking about investing, they are being challenged quite a bit at the moment, because we have these whole new ways of thinking about what are the opportunities in the stock market, and they are driven very importantly by your question, namely, what are the drivers which determine whether consumers come back, and do I have those drivers in my framework for when I think about whether companies are going to do well, and in particular also this issue about regional aspects of which companies are present in which regions. A restaurant chain, is a chain present in the tri-state area, New York City area, or is it present in parts of the country where you're not going to see the same growth rate come back as quickly?
So, Torsten, given what you're saying, remind us, because I think we talked about it the last time we spoke with you, what your GDP forecast is, and whether you have a range for that forecast that is wider than usual because of all of these factors that you're talking about, from regional effects to what do rolling reopenings look like, to what does consumer spending look like, and do people come back? What kind of predictions are you able to make right now?
Absolutely. I mean, I think the clip you just showed from Warren Buffett illustrates everything. We know what will happen over the next week. That's why putting together a GDP forecast for the Fed, for us, for the Congressional Budget Office, is very complicated, because I just don't have a toolbox that's very equipped to understand these issues that we're talking about here. Namely, where in some states have a much higher unemployment rate and others have a low. What does that mean? What are the different probabilities of a second wave, not even in the fall, but even here in the short term? As we just spoke about, that the overall virus curve is barely beginning to move down in the US, is moving here where we are in the New York City area, but it's not moving down at the nationwide level. So you're right, GDP forecasts have those forecasts have a much wider deviation than usual, which complicates also a lot of these things. But I think from a market perspective, what's most important is that the Fed, and Jay Powell said this last week also, I know you also spoke about this, of course, on Wednesday and Thursday, namely that when we don't know what will happen, then Jay Powell is literally throwing the kitchen sink at it and saying, we just hope that we will not get the financial market turbulence to magnify the downside risks. It's sufficient. We already have a significant downside from the doors being closed in corporate America. So the answer to your question, Julie, is I really don't have a very good scientific model for what can tell you exactly what the unemployment rate will be. But I do know that the Congressional Budget Office says that it will be 10% a year, and I do know that this quarter will be worse. So what we are seeing at the moment is that it looks likely, in the jobless claims, which is hard data, things are slowing down in terms of the deterioration. So it looks likely that the data is gradually getting better, but we have dug ourselves into a hard, deep hole here that it will take quite time to crawl out of. I think that's something that we can all agree on.
Yes, indeed. Unfortunately, that's one of the only certainties out there right now. Torsten, it's always good to see you. Stay well. He's the Deutsche Bank Securities Chief Economist. Thanks, Torsten.
Thanks for having me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.